Picture this. You've just stepped into retirement. The years of commuting, the long hours, the late nights are behind you. You're ready to relax, to travel, to spend time with your grandkids, or simply enjoy the slower pace of life. But just as you start to live that dream, the market falls, stocks tumble, your retirement savings take a hit. And now you're not just watching numbers on the screen, you're wondering if your lifestyle is at risk. Do you keep taking the same withdrawals? Do you cut back on spending? Or do you take on more risk and try to make it all back? For retirees, these aren't abstract questions. Market crashes aren't if events, they're when events. We don't know the timing, but we know they'll happen. And if you're in retirement, the impact can be magnified. So the real question is, how do you protect your portfolio so the next crash doesn't derail your retirement? That's exactly what we're going to talk about today. Hi, I'm Stefano Francesca, certified financial planner professional and senior wealth advisor at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. It really helps more Canadians see this. And if you'd like to see how well your own plan and portfolio are protected from market downturns, you could book a time with me using the link in the description below. Number one, understand the sequence of returns risk. Let's start with something that most people don't hear about until it's too late. Sequence of returns risk. Here's what that means. Two retirees could both average, say, 6% returns over 20 years. But if one of them experiences a crash early in retirement while they're also withdrawing money, their portfolio can end up in much worse shape than the person who experienced the downturn later on. Why? Because when you take money out of a shrinking portfolio, you're locking in losses. You're essentially digging a deeper hole for your investments to climb out of. Even when markets eventually recover, your balance may never catch up because those dollars are already gone. Market corrections happen on average every 3 to 4 years, and they produce declines of about 14%. Crashes of 30% happen far less often, but they do occur. If your equity allocation drops, say, 20% right as you begin retirement, you would need 25% growth just to get back to even. It's tougher to get back to even if you're taking regular withdrawals and depleting your portfolio at the same time. If this happens in early retirement, it handicaps further withdrawals. That's why protecting against sequence of returns risk should be the foundation of your retirement plan. Number two, build a cash reserve, your safety net. One of the simplest yet most powerful strategies is to have a cash reserve. Here's the idea. If the markets drop, you don't want to be forced to sell investments at a discount just to pay your bills. Instead, you draw from your cash cushion. That way, your investments have time to recover before you need to touch them. How much should you set aside? For many Canadians, 1 to 3 years of essential expenses is appropriate. This doesn't need to be sitting in your checking or savings account earning nothing. It can be in a high interest rate savings account, a short-term GIC, or even a conservative investment that doesn't move in lockstep with the stock market. For example, let's say a couple in Alberta spends $60,000 a year. If they set aside even 1 year's worth of expenses in cash or near cash, that gives them breathing room in a downturn. They don't have to panic, they don't have to sell all the way down to the bottom, and they don't have to change their lifestyle overnight. This reserve is not about maximizing returns, it's about creating stability. And in retirement, stability is often more valuable than squeezing out every extra percentage point. Number three, have the right asset allocation. Many Canadians approach retirement with portfolios that are too heavily tilted towards equities. That might have worked while you were working and had decades to ride out volatility. But in retirement, the math changes. Stocks are powerful growth engines, but they can be unpredictable in the short run. And if your portfolio is heavily tilted to equities, a crash can cut deeply into your income plan. That's why effective allocation matters more than ever. Bonds, GICs, dividend-paying stocks, varying management styles, and even alternative assets can all play a role. The idea isn't to eliminate risk, because you can't, but it can be managed. Think of your portfolio like a stool. If it only has one leg, one asset class, any wobble could tip it over. But with multiple legs, the stool is steadier. Now in Alberta specifically, I often see retirees with a lot of their wealth tied up in company shares or even in oil and gas investments. That concentration can feel familiar and even profitable when times are good, but can also expose you to unnecessary risk if the sector struggles. A crash in one area shouldn't mean a crash in your entire retirement. That's the power of proper asset allocation. Number four, have a withdrawal strategy, not just an investment strategy. Here's where many retirees go wrong. They spend years building their portfolio, but very little time planning how to draw from it. A withdrawal strategy is every bit as important as an investment strategy. Without one, you might pull money out randomly or even across all accounts, regardless of what's happening in the markets or with your taxes. That can lead to missed opportunities and higher risks. The better approach is to be intentional and strategic. For example, in a market downturn, you might draw more from your fixed income side, preserving equities to recover. We would even recommend rebalancing the portfolio to sell an asset class that is even or up in value in order to buy one that is low. If your income is pushing you close to the old age security clawback threshold, you may choose to take some income from your TFSA instead, since it doesn't count as taxable income. If you're under 71 and still holding RSPs, you might strategically withdraw smaller smaller amounts in down years to smooth out your tax brackets rather than waiting for forced withdrawals later. These decisions aren't made in isolation. They connect. The order in which you draw from accounts can have a significant impact on what you actually keep in your pocket. The big idea, don't just think about what you invest in. Think about how and when you take it out. That can protect you just as much as your portfolio allocation. Number 5, stress test your plan before a crash happens. This is one of the most overlooked steps, and yet it's one of the most powerful. Too many Canadians wait until after a crash to ask, what now? By then, the damage is already done. A better approach is to stress test your plan in advance. What does that mean? A good retirement plan doesn't just assume steady growth year after year. It tests what happens if markets drop 10, 20, or even 30% early in your retirement. If your plan can survive that scenario, if you can still cover your lifestyle, avoid tax traps, and keep your portfolio sustainable, then you can rest easier. If it can't, that's a sign you need to adjust before reality hits. Maybe that means shifting more into guaranteed income sources. Maybe it means building a larger cash reserve or a larger overall nest egg to build a cushion due to volatility. Or maybe it means adjusting your spending expectations slightly so you don't put your portfolio at unnecessary risk. Stress testing isn't about pessimism. It's about preparation. Dips, corrections, and crashes will happen. But when you've already run the numbers, you don't have to panic. You already know how you'll respond. Let's bring it all together. Protecting your portfolio from the next downturn isn't about predicting when it will happen. It's about being prepared no matter when it happens. That means understanding the sequence of returns risk so you know why timing matters. Building a cash reserve to buy yourself time. Effectively allocating so no single area can sink your retirement. Create a smart withdrawal strategy, not just an investment plan. And stress testing your plan so you already know how it holds up in tough markets. The reality is, retirement isn't about chasing the highest returns. It's about building a plan that keeps working even when the world gets unpredictable. We help our clients create certainty and peace of mind through effective planning, investment, and risk management. If you're a Canadian retiree or within 10 to 15 years of retirement and you want a personalized strategy to protect your portfolio and your plan against uncertainty, click the link in the description to book a consultation. Let's take the next step.